First order of business is approve the minutes of the meeting of April 14th, 2016.
Move the item.
Motion and a second. All in favor? Aye. All opposed? Motion carries. Item 3 is to receive the reported judgments for the month of March 2016 in the amount of $233,298.48. Motion and a second. All in favor? Aye. All opposed? Motion carries. Item 4 is to ratify the following approvals. Motion and a second. All in favor? All opposed? Motion carries. Item 5 is to approve the claims docket.
Second.
Motion and a second. All in favor? All opposed? Motion carries. Item 6 is to approve the following applications for service retirement. We have 6 applications this month. Motion and a second. All in favor? All opposed? Motion carries. Item 7 is to receive the report of death and approve the continuation of pension to the spouse. We have 1 case. Motion and a second. All in favor? All opposed? Motion carries. Item 8 is to receive the report of death, authorize the secretary to make necessary changes to conform on the following. We have 1 case. Motion and a second. All in favor? All opposed? Motion carries. Item number 9 is to approve the following application for vested rights. We have 1 application this month. Motion and a second. All in favor? All opposed? Motion carries. Item 10 is to receive a presentation from Jonas Rosson or his representative concerning his application for disability in the line of duty allowance as permitted under the disability allowance provisions of Section 4106 of the Oklahoma Municipal City Code as amended, and enter into executive session with the municipal council to discuss the application. Mr. Williams.
I think in this case we probably need to spend 5 minutes in executive session. Let me fill you in on, just so you have all of the facts before you, although our recommendation is going to be to go ahead and pay the...
Approve the application?
Yeah, to move the application. But I think you need to know all the facts in order to make that decision.
So we need a motion to move in. Entertain a motion to move into executive session. Motion a second.
This will be a roll call vote.
Roll call vote.
Okay. Ames? Freeman?
Yes.
Nichols? Yes. Shoup?
Yes.
Story? Thurman?
Yes.
Williamson?
Yes.
And our chairman, Bronson.
Yes.
Okay, it's unanimous.
So we will go into executive session and return momentarily.
doing? They must have been.
Okay, we're back in session, and I will entertain a motion to approve the application on item number 10.
So the item.
Motion is second. All in favor? All opposed? Motion carries. Item 11 is to discuss and/or authorize the audit contract with Allen Gibbs and Hulick LC to perform the annual audit for period of July 1st, 2015 through June 30th, 2016. Motion is second. All in favor? Aye. All opposed? Motion carries. Item 12 is the investment consultant report. Jason?
Okay, good morning, everyone. I have a couple of items this morning. We have the quarter report and the monthly ASAP, and then we have just a review of some potential candidates for the replacement for Von Tobel as your emerging markets manager. Really, the purpose of this today is just to show you the candidates we've narrowed a list down to, and then decide how many you want to bring in next month. I'll get to that secondly. So if you would just turn and tab 1 of the quarter report to page 11. I know we talked last month about really the quarter end, but it was really a tale of two markets during the quarter. The first 6 weeks through mid-February, we saw pretty significant declines in the equity markets. I'm in the brown book, just so there's no confusion. Pretty significant declines in the equity markets as oil prices coming down, treasuries, U.S. treasuries coming down as with a flight to quality, non-U.S. and particularly emerging market currency spreads widening out relative to the dollar, putting pressure on those bond prices. And so within your portfolio, a lot of those things were not good. Those were headwinds for the first several weeks of the quarter. Things then turned around beginning mid-February with the ECB's announcement of expanding their bond purchases. That really kind of ignited equity markets, along with oil turning around, and oil from February 11th to the end of March was actually up about 50%, from $26 to close to $40. So the two things that really took off were oil, energy, and materials that were down the most. And from a broad equity market standpoint, really those two sectors did well, but globally, emerging markets rebounded, emerging market equities rebounded, but U.S. stocks, large and small overall, and international developed markets were roughly flat. So you did see a benefit in March to your emerging markets were up, and your global bond portfolio with Brandywine, with all the EM currencies, that bounced back pretty big and was up about 7% during the month. But those things were also, as we look at one-year results, are the biggest negatives to your total return relative to your policy. So just looking at one-year numbers here on page 11, you can see relative to long-term objectives, it's been a pretty challenging year if you're a long-term investor with a 7.5% to 8% type return target. Treasuries, the best performing asset class over the last year, up 2.39%. And you can really think about the 10-year Treasury. It went from 2.2% yield at the end of the year to today it's at about 1.74%. So as yields come down, prices go up. But as you know, as a long-term investor, and with that very low yield, that's not a great thing overall for markets. The Barclays aggregate, which is just the broader U.S. investment grade market that we benchmark your bonds to, up a little under 2%. Large cap stocks up 1.78% in the last year. So from an equity standpoint, U.S. large cap stocks, the best place to be, and it's not a very good return, little under 2%. Everything else is negative, with emerging markets and then commodities being the worst. You can see year to date, a little bit of a bounce back. Emerging markets up almost 6%, while other things are negative. All of that really came in the month of March, not during the quarter. So just moving forward to tab 2 and looking at your portfolio, I'll go all the way to page 26, and then also looking at the April flash report in terms of asset allocation. Overall, your asset allocation, your portfolio is roughly in line with targets, slight overweight to equities and fixed income, primarily a result of just not being fully implemented in the real estate. The opportunistic real estate is underweight, 3%. That's your private real estate portfolio that acts like private equity, not fully implemented yet. So overall, real assets are about 3% underweight. The real estate overall actually did very well for the year. The Morgan Stanley strategy and core real estate in general was a nice diversifier in a year where stocks and bonds did not do that well. Within equities, a little bit of an overweight to U.S., large and small. The large cap overweight has been a positive, as large cap did a little bit better. Underweight to other areas, international, and slightly underweight to emerging. Within fixed income, the allocation to core plus bonds, again, recently the core plus we're including, that's the Western portfolio. Western has done well, as high yield has done very well since February 11th. The absolute return strategy, that's PAMCO, this has been a more challenging area. You've got longer term, really this is designed to mitigate against interest rate risk, rising interest rates. Short term, this has been pretty painful in the near term. As rates have come down, you're not getting the benefit of declining rates in this portfolio. And there's also some, while very low volatility, there's equity exposure within the absolute return portion of PAMCO. And so from a comparative standpoint, this has been pretty challenging. I point this out, and we've talked a lot, and I know there's a lot of news about hedge funds currently, and we're certainly not abdicating our position on hedge funds. We think they make a lot of sense, and we need to just frame why you have the different portfolios, different hedged strategies within your portfolio. The absolute return strategy is really designed as a fixed income surrogate to mitigate against interest rate risks and provide you a premium return to low yielding bonds over the long term. Long short equity is designed to really be an insurance against equity market volatility. It really has done that very well. And up until now, the absolute return has done its job as well. One of the things that we're spending a lot of time on currently is over the last several years, there's really been an evolution in the marketplace of more liquid, absolute return strategies that are more focused primarily on credit. And what I mean by that is these are bond managers that are offering daily liquidity strategies as opposed to a hedge fund strategy like this, which offers quarterly liquidity, and they're investing in some less liquid underlying securities, and they may have some distressed debt and other things in it that injects a little bit more volatility to the portfolio than perhaps is necessary. So that's something that we're looking at. I want to come back and talk to you about that later this year, because I think that's something where we can make some tweaks to the portfolio, not changing out that target of 5% to absolute return within fixed income, but changing out how it's implemented to perhaps a more liquid, transparent type strategy with daily liquidity that's focused more on traditional fixed income type instruments. So I just wanted to bring that up at this point. Page 27, relevant, I guess, today because we're going to talk about your emerging market allocation. This is just on a look-through basis. We're looking through all of your strategies to identify any exposure to EM. Of the total portfolio, you have about 6% in equity exposure, and then you're getting some non-equity or fixed income emerging market exposure through the Brandywine strategy, and that's been a big positive over the last month or so. Page 28, just to reiterate, longer term as we look at the portfolio, it's doing what we would expect, although this last year, and the endpoint is how we see returns is very endpoint sensitive. So this is going back, the upper right and the risk return chart on the upper left, this is going back to January of 2002, so this is about a 14-year period. The portfolio has returned 6% annualized, relative to the policy index of 5.96, so roughly in line, but with about 80 basis points less risk. So we would expect this is how this portfolio tends to behave. It's constructed to generate a return in line or slightly better than the asset allocation would suggest, with less risk, and you're getting that over time. I think the chart in the lower left is a good one to look at. It's a good reminder of where you have been, where you've come, and how over time, just being patient, your dollars grow over time. So if we look at this isn't your portfolio exactly. This is showing a dollar invested in this portfolio in January of 2002, how that dollar that was invested in January of 2002 has grown over time. So that $1 grew to $2.40 approximately, and has dropped down a little bit, but it's still above. Every dollar that was invested in January of 2002 is now worth a little over $2.20. And there's been ups and downs, but you can see where we've come from 2008. That's a pretty long, steep incline. Not surprising that we're seeing some dips right now, and it's a little bit challenging moving forward. Page 29 just looks performance relative to peers and policy. The 1 year has been a bit challenging. That the light blue bar, the first one, is the net of fees, and then the dark blue is gross of fees. and then the green is the policy index. The gold is peer group universe of other funds between 55 and 70% equity, so a similar risk allocation, and then the purple is the public fund universe. So over the last year, your portfolio is in the 61st percentile versus other funds with a similar risk allocation to equities, and in the 77th percentile versus public funds. What we're seeing there really is the last quarter, the hedge fund allocation and active management overall has been somewhat challenging. The first 2 months, January and February, hedge fund managers and active managers had a little bit more risk in their portfolio, underperformed, and then took risk way down, and markets bounced way back and did not keep up in those months. If we look at the next page, however, just looking at different cuts in time, you can see the last 3 of the last 5, really, well, the 4 of the last 5 years, with the exception of this year, this portfolio has outperformed both on a net or gross and net basis, the policy index and peer groups over every one of those periods prior to this year. So there's going to be times we're not always going to be in the top third or top 20% like you were really 3 of the last 5 years, and going back to 2012 in the top 37%. But the areas that have hurt have been the hedged strategy on the equity side the last 2 months, and then on the fixed income side relative to the policy index, some of it's the hedge funds and also the Brandywine EM exposure relative to a Barclays aggregate index, which is what we're comparing all of your fixed income to, where treasuries, as treasury yields have come down, that has dominated. Having interest rate sensitivity is what has dominated, and we've tried to take out as much interest rate sensitivity in your portfolio as possible to mitigate against low yields to rising yields over time. And in the short term, that hasn't been beneficial. From a manager standpoint, no issues with the exception of the one that we'll address today and next month, hopefully, which is the emerging market strategy. As you know, Vontobel was terminated, and that portfolio was liquidated in April. The proceeds from that were reinvested mid-month in an SSGA Emerging Markets Index Fund. So it's not reflected in the quarter report, but it is reflected on the April report that the SSGA EM index has $19.5 million. That's intended as a placeholder until a new active manager is selected. That fund has daily liquidity, so we can get in and out on a daily basis. So if you would, unless there's any questions on the quarter report or the monthly ASAP, I'll just turn your attention to the clear covered book. So with Rajiv Jain's departure at Vontobel, there has been a number of redemptions from that strategy, a lot of activity in the emerging market space, coupled with it was a tough couple of years in emerging markets. So asset values for a lot of emerging market managers have come down, and I bring that up because that actually creates opportunity. Emerging markets is a capacity-constrained area, so a number of managers have been closed over time, not taking in new money, and now have reopened to new candidates or to new mandates. So we took that opportunity to do for some of our other clients that have procurement process where they have to issue RFPs. We've done some fairly large public RFPs where we've got back close to 70 to 75 responses from managers, from emerging market managers that we've vetted and looking at to narrow down a list and come up with a couple of new names that you'll see here. Well, really one that you'll see here. It is fairly new to us, but we think it's been a good healthy opportunity to relook at the asset class. So as I mentioned, we went out and really started from scratch, took this opportunity and looked at over 100 different managers, looked at them on various quantitative screens, looking at returns in up and down markets, risk, consistency of returns, narrow down a list based on that, really to the top half. We don't want to just pick managers that have done good looking backward. We're trying to focus more on qualitative factors and looking forward. So then 75% of the analysis is looking at the firm, stability of the firm, compensation structures, regulatory issues, the people, the stability of the portfolio management team, their process, is it repeatable, sustainable, understandable, and do they stick to their knitting? And then also looking at the delivery of the strategy, the vehicle. Is it competitive from a fee standpoint? Do they offer vehicles that make sense for clients? So we've, and then most important, is it a fit within the portfolio? So within your portfolio, really what we're talking about is about a 3.5% overall allocation to this manager, because you have another EM manager in Wasatch that is focused on emerging market small cap. So what this is intended to be is a more all cap, bigger name emerging market manager, investing in bigger names, not small cap names within emerging markets, as a complement to Wasatch, as well as a complement to your other managers in Lazard and Harding Loevner. So the four managers you'll see on page 1, familiar with one of them, certainly, Harding Loevner, which is your international growth manager. They also offer a EM strategy. It is the same, they leverage the same analyst team. They're broken down by industries and sectors as opposed to regions. And it is the bottom-up fundamental process that they utilize for their international growth strategy. More of a GARP, or growth at a reasonable price. So relative to what you had with Von Tobel, I'd say this is the most similar to Von Tobel's strategy in terms of style and approach. The second manager is a bit of a newer manager for us in the EM space. We're very familiar with them on the international growth space. We've been following this strategy, which has very good returns. WCM, they're a manager out of Laguna Beach, boutique firm. All they do is non-U.S. growth equity investing. This strategy, you can see the assets in the strategy are $200 million. Pretty limited strategy assets. Most of those assets are actually in a manager of managers vehicle through SEI on a platform that you could not invest in that strategy, but they do have a mutual fund and a institutional commingled fund or limited partnership that they've just created for a corporate pension plan. It's small assets. It's like less than $10 million in assets currently. We included them because the numbers are so good and because we like the firm. This strategy is a bit unique in that it's just getting off the ground. We think there's probably some leverage to be had in fee negotiation with them. The other issue with this manager, or just something to point out, is it is a very concentrated strategy. They run 20 to 50 stock portfolio, generally in the 30 name range. They are doing this primarily through ADRs. So you could actually have a separate account with this manager. ADRs are American Depository Receipts, so they're not buying ordinary shares, they're buying ADRs. Historically, we've shied away from that because it limits the opportunity set, but again, when we look at the numbers are so good that we felt that we should include them. Next is the Wells Berkeley Street. I think Wells was in the search the last time when you hired Von Tobel. Wells is Berkeley Street Team it's a boutique within Wells Capital Management or Wells Fargo Capital Management. This is a bottom-up fundamental strategy. This is a more core-oriented strategy, a broad core strategy, good track record, deep team. We'll certainly like this strategy as well. And then William Blair, the emerging leaders. This strategy was closed. It has reopened. So this is one that we were able to reconsider, that we've have some number of clients in previously, but it's been closed for a number of years. This is, again, they're all growth strategies. Within the EM, while you can get into value, we think based on your size and a single mandate, none of these are really momentum growth, so they're not real high-octane growth. They're more, while Harding Loevner describes themselves as GARP, all three of these are going to be they're focused on some downside protection, high-quality growth. We tend to shy away from just having a single value manager or a momentum growth in emerging markets. It just, unless you have a broader or bigger allocation, we think it'll create a lot more volatility than necessary. So wasn't intending on going through numbers or anything today. I think the purpose was just to introduce, here's the four candidates, and leave it to the board's pleasure as to how many you want to interview. In the past, I know we've done 2 or 3. The reason we showed 4 today is because we thought a couple of them, Harding Loevner, you have in your portfolio already, although we think it's certainly a good strategy. And then WCM is one that has some factors that may not be, you may not want to consider. But we certainly are comfortable with all 4 of these managers, and it's just really a time factor for you as to how many you'd like to interview. Again, and there's no...
Jason, I had a question on page 1 real quick, if I could, and please excuse my ignorance. On the holdings range, what is that exactly?
Holdings range?
Yeah, how are you defining that?
It's defined by the manager as typically how many stocks will they hold in their portfolio.
Okay.
So that's what I was mentioning with the WCM. This is a concentrated, it's a concentrated strategy, and typically they're going to be at about 30 to 35 names. It's very concentrated.
Okay, thank you.
Strategy.
Jason, what's the turnover, annual turnover range? That's not personnel, that's stock.
No. That's of the portfolio. Yes.
Okay.
And most of that, and quite honestly, turnover for tax-exempt investors, I don't really look at it as a major issue because it's not creating any taxable issues for you. It does create cost, but it's more what you'll see with a manager within your portfolio like an Intech. Intech is a quantitative strategy. They optimize the portfolio every day, so their turnover is going to be over 100%. And that's primarily trims. They're letting the stock goes from 1% to 1.5%, and they're trimming it back to 1%. We look at this because all of these managers would describe a buy and hold strategy. They're long-term investors, so you would expect the turnover to be fairly low within their portfolios. They're selling about 1/3 to 1/2 of their portfolio in any given year, but some of that is also trimming when stocks go up and down.
Are we thinking of possibly doing the interviews next month?
It's your pleasure. I'm not sure what's on the agenda next month, but
Yeah, I'm not either with Renee not here. I'm not sure.
But
What's the pleasure of the board? Would we rather wait until July to do the interviews? Anybody have an opinion?
Like you said, depending on what's on the agenda.
Okay.
Next month, that's usually we go.
so maybe the first thing is to decide how many you want to interview.
Yeah.
Well, I'd probably trim Hardy Loevner, just because you got,
Yes.
have a relationship with them already. You're getting a little bit of their EM exposure on their developed strategy.
I don't know, I mean, I'd be interested in hearing the WCM invest.
I am too.
I'd be interested
Pull that
in,
one out and do three.
yeah. Let's go ahead and do all three. Let's do WCM, the Wells Berkeley Street,
And Blair.
William Blair. Let's do
Okay,
that.
and we'll keep them to 30 minutes each.
Yeah. Okay.
Okay, and then I'll talk to Renee. We can either do it next month, or we'll figure out what board meeting's the best to do it based on board schedule and what else you have going on. Okay? Thank you.
Thanks, Jason. Okay. Item number 13 is comments from board, staff, and citizens. Mr. Smith, I see you in the audience. Do you have any comments for us today?
No, sir.
Very well. Not hearing any comments, we are adjourned at 10:42. Thank you.